All right. Well, thank you so much, Sadia. I appreciate it. I appreciate those that are with us here tonight. Thank you for taking the time out of your evening. I know we're all very busy and probably a little zoomed out if you're anything like me, but so I really do appreciate you joining us here tonight. So it's wonderful to see that you're taking some time to hopefully try to improve your credit score. So with that, we'll go ahead and get started. If I can get to my next screen here. Oh, there we go. All right, sorry about that. So to improve a credit score, you should understand really what credit is, right? And understand that credit is really a privilege. It's not necessarily a right that we have. So I do want to start off by letting you know that this session we're really just talking very general credit. So one of the things that you do want to be aware of is that there are two major credit score models that we'll be talking about. That lenders really use nowadays to determine your credit worthiness. So, I've got the definition for credit here. Really, credit is just the fact that you have borrowed money and that you have promised to pay that back at some point. Typically, it includes interest, may include some fees for obtaining that credit. But that's really all that it is you are borrowing money for hopefully a short period of time. And hopefully we'll try to get the best rate and try to pay the lowest possible amount of interest that you possibly can. So with the two credit bureaus that I mentioned just previously, or credit score models, those are Vantage and Fico. And Vantage was made up by three major credit bureaus. It's a little bit newer model, but it is really gaining ground when it comes to who's using it. So 9 out of the 10 largest banks and 29 out of the largest 100 credit unions are actually using Vantage now to decision their consumer loans. Consumer loans meaning mostly personal loans or maybe unsecured loans, car loans, not necessarily your home equity loans or mortgage loans. Those are considered residential loans. But a lot of the banks are actually using Vantage scoring model to decision their consumer loans now. The FICO score model is one that we are probably a little bit more familiar with. It's been around for a much longer time. Banks are still using the FICO score model to decision most of their residential mortgage loans, home equity loans. So you just want to be aware that there is a difference between the two of those, and we're going to go ahead and look at what the difference is there. Oops, sorry, my computer is kind of delaying here for a minute. So the FICO score model, as you can see here, is made up of 5 different factors that they're taking into consideration when they're putting together your credit score. As you can see, the main focus for FICO is your payment history, right? So how have you paid in the past? Is there any late pays? And when we're talking late pays on your credit report, we're talking about when you're more than 30 days late, okay? So, when we're talking your actual lender or credit card company, they may give you a grace period of maybe 10 or 15 days, depending on the type of loan and the lender that you might have that debt with. And if you go past that grace period of 10 or 15 days, then they charge you a late fee. However, know that that's not necessarily going to affect your credit score. The only late payments that are actually affecting your credit score are when you are more than 30 days late. Okay, so when we look at payment history that's being taken into account here, they're really looking at when you are more than 30 days late. That is what's going to affect that credit score. Anything under 30 days should not be affecting your credit score. The second biggest factor with FICO is the amount of debt that you owe. So The more debt you have, the more debt you accumulate over time, the more it can potentially affect your credit score. So with that being said, as you can see here, between those two, 65% of your credit score is made up of payment history and how much debt you actually owe. Okay. The other 35% here is made up of how long have you had credit for, right? Meaning, when was the very first loan or credit card that you ever obtained? That's 15% of your credit score right there. And then that last 20% is how many inquiries do you have on your credit report? If there's continuously inquiries, on a monthly basis, that can really hurt that credit score. As you can see, up to about 10% every time. So, and then that credit mix is that last 10%. So do you have nothing but credit cards? That can be holding your credit score down a little bit. Or do you have only 2 car loans? That can be holding your credit score back a little bit as well. Because again, it's payment history, and it's also kind of that mix, how do you manage your money? Really, it comes down to how do you manage your money by making those payments? Well, it's a little bit harder to manage your money when you're making a credit card payment, right? Because that credit card payment could change or could vary from month to month, depending on the balance that you maintain. Whereas a car loan, it's usually a fixed payment. It's not going to change. It's usually due on the same day every month, and it's for a set period of time. So you may have that car loan for 3 years. You may have that car loan for 5 years. At the end of that, it's done. It's over with. So, what that credit mix also plays a factor, because you want to be able to show that not only can you make a payment that's the same for the next maybe 60 months or 5 years, but you can also make the payment on a revolving line, right? Your credit cards are revolving lines of credit. Again, that payment's going to depend on how much you have used of that line. So that payment will be different. That minimum payment might be anywhere from $25 up to $75, $100. You making those payments on those credit cards shows that you can afford and manage your money well enough to make either one of those payments. So that's what FICO is really looking at. Now, Vantage is looking at your credit a little bit differently. The main difference between the two of these is that Vantage is looking at 6 factors compared to FICO is only looking at those 5 factors. Now, here you can see that payment history has a lot more weight to it than it does with FICO. So again, the similarity is that your payment history, it's what's really being considered here. And something for you to think about it this way, because you may be asking yourself, why is my payment history really have this much weight? Why is 40% of my credit score based on how I have paid in the past? Well, if you consider, let's say that a friend asked you to borrow $100 for a week, right? If I came to you and I said, hey, or I said to Sadia, right? I know Sadia is still listening. She's still with us. Sadia, can I borrow $100 for 1 week? I just need it for 1 week, real short term. And I paid Sadia back in a week. She'd be happy, right? She lent me $100. I told her I'd get it back to her in a week, and I got it back to her in a week. Likely, she might borrow me $100 again at some point, right? Maybe depending on how often I ask. But however, if that same friend, if I came to Sadia again and I asked her to borrow $100 and she said, that's fine, when can you pay it back? And I said, maybe in a week or so. And 2 weeks go by and I still haven't said anything to Sadia. I still haven't paid her the $100 back. And now Sadia's kind of like, well, she said a week, it's been 2 weeks. I'll give her another week, right? We're at 3 weeks now. And at this point, maybe Sadia is kind of like, all right, I guess I have to do this. I have to go and ask Marlon for my money back, see what's going on. And now she asks me, and I say, well, you know what, Sadia, I'm having a hard time. I know I just borrowed that $100 to buy this pair of jeans. It's not a big deal. I'll get it to you. Right. And another week goes by, and now it's been over a month. And now Sadia's like, yeah, hey, do you have my $100? And now this is putting a little bit of a strain on our relationship, right? This is exactly what your credit score is telling your creditors, your lenders, right? How trustworthy are you? Sadia is less likely to borrow me money if it took me a month or more than a month after we discussed that I might get it back to her in a week, right? So this is exactly why payment history has so much weight when it comes to your credit score. So whether it's with Vantage or with FICO, as you can see, it carries a lot of weight. So one of the very first things that I will say is if you are looking to improve that credit score, really look at your payment history on your credit report. Right now, annualcreditreport.com is probably the best place to go and get your credit report. You're due one free copy of your credit report by all three of the major credit bureaus, TransUnion, Equifax, and Experian, once a year. Now, due to the pandemic, as of right now, until April 20th of this year, you can pull your credit report on a weekly basis for free from any of the three major credit bureaus. That's so far, it's until April 20th of this year. They extended it last year. So for the last year, you could have been looking at your credit report on a weekly basis. However, there's lots of, credit cards right now are offering you your credit score and credit report. A lot of your large financial institutions, if you are a member with KCT, we offer you to look at your credit report and a credit score. All you have to do is log in, and you can look at that every 24 hours. It gets updated. So I would suggest reach out to your financial institution or maybe your credit card company and check and see, how often can I look at my credit report and my credit score? And really look at that payment history. What does your payment history say about you? Do you have 30-day late pays? Do you have 60-day late pays, 90-day late pays? Do you have collections out there? In our little example that I set here for myself and Sadia borrowing money, the longer it takes me to get that money back to my friend, the more strain there is on that relationship, and the less likely they are to lend me money again. And the less likely anybody else that she has a possible conversation about it is to lend me money as well. So the only other thing that I wanted to point out with Vantage is they take into consideration your credit utilization. That's 20% of the Vantage credit score. What that means is how much of that credit card limit have you actually used? For example, if you have a $1,000 credit limit and you have used $200 of that credit limit, meaning you purchase something for $200, you're using 20%. So you're at 20% utilization. However, if from that $1,000 credit limit, you have used $900, now you're at 90% utilization. That's really close to maxing out that credit card. The higher your utilization is, the lower your credit score is going to be. Because what it really says to creditors is that you're basically living off of these credit cards, right? You're not paying down that balance, which also turns into debt. And as you can see, what the balance of your debt is, right? So 11% of that is taken into consideration when it comes to Vantage. So there's obviously a lot of factors that kind of go into what makes up your credit score. What you really want to keep in mind is that credit history, that payment history, is crazy, crazy important. And for the most part, those that have lower credit scores, they're mostly due to late pays, meaning 30-day, 60-day, 90-day late pays. And they're also due to collections, meaning you already went past all those late pays. The company has basically given up on you paying them. So they've sold your account to a collection agency to try to get that collected. But it means that you had so many late pays that it went into collections. So that's really what most of the time ruins our credit scores is that payment history and those collections, which really kind of translate to, again, that kind of trustworthiness when it comes to lenders and creditors. So just a really quick example about how your credit score can actually be used to your advantage. So in this scenario here, if you were to purchase a vehicle and try to finance $35,000 over 5 years, if your credit score is 780 or better, likely you can have that entire $35,000 financed, as long as that vehicle is worth $35,000. As you can see, the interest rate on that would be at about 2.5%. And I'm basing this off of KCT's interest rates. So don't hold me to any of these rates, but unless you came to KCT. But I'm basing this off of what we know here at KCT. With a credit score of 780 or better, we would finance 100% at a rate of about 2.5%. And then as you can see, your payment there and the total interest that you will have paid over 5 years would be just under that $2,300. Sounds great, right? I'm not going to go over all of these, but scenario C shows you if your credit score was kind of bad, right? Because anything under 620 is not considered good. If your credit score was, let's say 619, you would be asked to put a 20% down payment on that $35,000. Your interest rate goes from that 2.5% potentially to 17.24%, 17.25%, which is crazy to think about, that the credit score can affect you that much that you could pay an extra 15% interest just based off of that credit score. And as you can see, the total interest paid in scenario C is almost $15,000 compared to less than $2,300, right? So that's the kind of power that your credit score really has. So in trying to repair it, obviously, definitely a good option. Because again, it really comes back to your credit history is telling those lenders how you will pay. How have you paid in the past, whether far or near. Typically, most of your lenders are looking at the last 24 months. So the further you get away from any late pays, the better. Unfortunately, not a whole lot that you can do as far as turning the clock backwards. We can only really kind of look forward, to see how can we actually help improve that credit score. But reviewing your credit report on a regular basis is so important, especially if you're trying to improve that credit score, right? So making sure that you're reviewing and making sure that there's actually accurate information. And I did pull and just would like to share with you here real quick to give you an idea of what a credit report is actually going to look like. So bear with me here. I can pull this up for you, hopefully. All right. So as you can see here, I pulled up my credit report earlier today. This happens to be with TransUnion. That's the TU at the very top there. Shows you the date that it's pulled. What I highlighted there is that this particular credit, so I started my credit back in 1994. So this is saying that September 1st, 1994 is when I had my first trade line. When you're looking at your credit report, if you're looking at it for the first time, you want to make sure that you're looking at all of your personal information. Make sure that it is all accurate personal information. It's just going to, your social security number, your name, your birth date, your address, your previous addresses, right? So there you can see other addresses. Your previous addresses should also be accurate. So all of the information that you're looking at on your credit report should certainly be accurate. Your employers, past employers, if any of this information is not accurate, you really want to correct that. And one of the reasons that we want to have that corrected is because while I might think that I'm one in a million, I am sure that somewhere in the world, there's another Marlon. There might be another Marlon Glenn. There might be a Marion Glenn. There might be a Marilyn Glenn, a Marlene Glenn. And if any of this personal information is not mine, it could be one of these other people's, right? So making sure that my information is correct makes sure that they're not crossing any information with anybody else. Because if they're crossing information, even if it's something as simple as a past address, I've never lived in Florida, but if they have a past address in Florida, well, then they're crossing information with somebody else. So you want to make sure that when you're looking at your credit report, that all of the information on there is actually yours. And you may not remember, but you have an idea, right? We all kind of have an idea of, either the street that we lived on or, roughly who we worked for. Maybe some of us might have had 20 employers in the past, right? So we kind of have an idea of our employers. What I also wanted to point out here on the very top of the screen, it tells you, is everything looking correct? And if not, it tells you, go to transunion.com/disputes. And while this is a PDF that I kind of took a scan of, that is actually a hyperlink. So it's that easy to just click on that and it'll send you to the disputes at TransUnion, and you can try to correct any information. So if there's a previous address that's not yours, then you would be able to say, this is not my previous address, please verify and correct this. And then I just wanted to show also, all the satisfactory accounts. So this is what this would look like. So I have a satisfactory account with American Internet Mortgage. As you can see, I highlighted that this is now closed, but this was a satisfactory account. This is what it would look like. It went on to kind of show all of the credit that I have had, year after year. I eliminated all of those pages. Since 94, that was a considerable amount of pages. But what I did want to show you here is that this particular account, this particular Capital One account, is currently still open and functioning. What I wanted to point out here is the utilization. So as you can see right here, I calculated, I was at 32% utilization was my max. It tells you here that I spent $2,442 at one point on this particular credit card, and my credit limit is $7,500. When I take that $2,442 and divide it by $7,500, my utilization is 32%. Okay, that was a little high because most of the time you want to stay within 30 to under 30%, right around 30%. So 32%, not crazy, but if you can maintain your utilization to about 30% on your credit cards, on all of your credit cards, that's going to help your credit score as well. Because again, Vantage takes that into consideration, specifically the utilization. And while FICO doesn't necessarily have it as part of their model, it does take into consideration your outstanding balances, right? How much debt you actually have. And as you get closer to those credit limits, FICO is taking that into consideration when they're looking at those balances as well. So very important that you keep track of that. So as you're looking at your credit report, take a look at that. What is my utilization? calculate that, right? So how much have I used compared to what my credit limit is? How much have I used? Divide that by my credit limit. That gives me that percentage of utilization. And minimizing that, shrinking that on those credit cards is really going to help your credit score as well. So I don't think there was a whole lot more here. Credit inquiries here. So your inquiries do stay on your credit report for at least 2 years. The less inquiries you have, the better. And we're talking inquiries where you're actually requesting additional credit. You're requesting an additional credit card. So when you say yes to that lady at Walmart or Old Navy or wherever you shop, and she says, would you like to save 15% today by applying for our credit card? If you say yes, that is an inquiry. That is what we call a hard inquiry, meaning you are applying for that credit card. That's a hard inquiry, and it is affecting your credit score. The less inquiries you can have, if you are at a point where you're trying to improve that credit score and maybe you have a lower credit score, stop saying yes to those people that are offering you those discounts because they're pulling your credit report. You inquiring into your own credit report through annualcreditreport.com or directly through TransUnion, through Equifax, or through Experian, that is not considered a hard inquiry. So it does not affect your credit score. It will still reflect as an inquiry on your credit report. It'll just show, hey, TransUnion gave you a copy or showed you what your credit was on whatever date, but it's not actually affecting your credit score in any way. So you want to keep that in mind as well. Getting a handle on net debt is also incredibly, incredibly important. So let's talk a little bit about that. How do you eliminate some of that debt, or how do you get a better credit score, right? So we've talked a little bit about the utilization and shrinking that utilization on those credit cards. We talked about how long you've had credit for, right? There's, again, not a whole lot that you can do about that. You started credit when you started credit, and the longer you have credit for, the better your credit score will be. One of the reasons for that is because there's more history to base that credit score on, right? So if you only have 6 months worth of credit history or payment history, that's a very short period of time. It's hard to know how trustworthy you are in just 6 months, right? But as you get to that year mark, that's a little bit more history. And, if you only have one credit card, that's really kind of shrinking what your credit score can be based on, right? So I usually will suggest to people 2 credit cards is really all that you need. Maybe 3 credit cards, depending on, if you have any other loans. So if you have a car loan, if you have a personal loan, maybe you're a homeowner, those all count as loans already. So reality, do you need more than 2 credit cards? Not really. Do you need 10 credit cards? None of us need 10 credit cards. Many of us may have more than a handful of credit cards, and that's okay as long as you are able to reduce some of that debt, keep your outstanding debt low, and keep that utilization low as well. So when it comes to outstanding debt, how do you eliminate some of that? That's what most of us likely struggle with. Now that you're telling me, Marlon, that I don't need 10 credit cards, but I already have 10 credit cards and a lot of them are almost maxed out, how do I eliminate that? How do I reduce that down? Well, we here at KCT like to use what we call the snowball effect. There's a couple of versions of how best to pay off debt. One is the snowball effect. One is the avalanche effect. I'm not sure why they both have to do with snow, but the snowball effect really works like this. You would complete a worksheet similar to this. And you would start with your smallest balance. So let's say, for example, that you have 10 credit cards, and the one with the smallest balance only has $100 balance on it, and the one with the largest balance might have $1,000 balance on it. Okay, that $100 balance one probably requires you to make a fairly small minimum payment. Let's say $20, right? Well, you would look at your budget and your spending plan, and you would determine that you have an extra $20 that you can apply towards paying off debt, right? So now instead of just making that minimum payment of $20, you're going to add the extra $20 that you found in your budget. You're going to make a $40 a month payment, right? Well, you only owe $100. At an extra $20, you're likely going to have that credit card paid off within 4 months or so. So now, once that's paid off in, let's say, 4 months, you now have an additional $40 that you can apply towards your next smallest balance. You've already eliminated the debt off of your first credit card, right? So now the point is you're going to try to eliminate the debt off of that next smallest balance. And that next smallest balance credit card might also just require you a $20 payment. But now, instead of making that just that $20 payment, you're going to send in that $20 payment plus the extra $40 that you were paying towards this other credit card. So you're going to send in an extra $60, a $60 total payment. And let's say that that balance on that credit card was only $200. Well, if you're sending an extra $40, that's going to eliminate that credit card within a couple of months. So in a year, ideally, you could have eliminated the debt off of 2, possibly 3 credit cards. And that's how it kind of just snowballs into a larger payment that you can make on those larger balanced credit cards. So that's really one theory, and we find that it's a good theory because it kind of starts small. It's not really overwhelming. Concentrate on just that smaller balance. It'll be such a victory. You'll feel so good once you pay that off. And then you'll realize that you can actually really do it. You can continue paying off those other balances as well. So paying off your debt doesn't have to be that hard. If you kind of start small, baby steps. And it could be as little as sending an extra $5, $10, whatever it is that your budget actually affords. So you really kind of have to sit down and look at that budget and figure out what is affordable to you. That will kind of give you a timeline of when you might be able to pay those off. This is, I wanted to also share with you, and looks like I logged off. So we're going to log in here. And again, this obviously is just with KCT Credit Union, but reach out to your financial institution to see if they offer you the option to sign up to be able to see your credit score. And again, the internet's a little bit delayed on my side, so hopefully we can look at this here. Okay, so this is our little Chester Banker is our little test subject here at KCT. So I've logged into his account, and really what I want to show is this right here, show my score. Okay, so here what we call this savvy money. So if you have, again, an account with us and you have never logged into this, you would click on show my score. It's not going to work for us here because obviously this is a fake account and he doesn't have a credit score. But our Chester Banker would then kind of log in to Savvy Money. He would set up his account and then he'd be able to see his credit report. And his credit report would look similar to this. It would start off just kind of giving him an idea of where his where his credit score currently stands. So this is obviously not Chester Banker's credit score, but I did pull up well, this is mine. So this is where I currently stand, right? So it tells me that I have an excellent credit score, right? It gives you your credit score there. Goes on to tell you where the grade is for your payment history. So my grade, I scored an A for payment history. And it goes on to give you all of this information, any recommended actions on how to improve on that. Again, whatever financial institution you're with, if they have something like this, if you maybe had a grade of a C, really looking at the recommended actions would be a great starting point for improving your credit score. Because a lot of those recommended actions are really based off of your particular credit score. It's really the system, the Savvy Money system is really looking at what your credit score looks like compared to people who have excellent credit scores. And then it's basing it off of that and giving you those recommended actions. So, credit usage, it's saying it'll even show you. So this one in particular is showing me that 30% mark there. That's where you want to stay under. So in this particular case, I'm at 22%. With that particular credit card that I'm using, and it would show you, okay, you're over that 30%, you're almost reaching 50%, right? So it would tell you exactly where you stand with all of that. And then it tells you, your account mix, meaning I have credit cards and I have, an actual mortgage. Is good. It's got a grade of A. How long I've had credit for gives you, so it's really nice. It goes on and gives you a grade for everything. So here I fell from an A to a B. And this is on inquiries, right? So I recently made some movements, shows me my inquiries. And so my credit score really did drop, right? It took a little bit of a hit. Whether I opened up a credit card, whether I refinanced my car, maybe I refinanced my home, took out a home equity loan, whatever the case was, I made movement. I requested additional credit. So somebody did a hard pull on my credit report. So my credit score went down. My grade on inquiries went down and reflected that as well. So I just wanted to give you an idea of where we were at with that and what that would look like. Again, whether it's with your own financial institution, hopefully it would look similar to that. But it's a really great start on, how to, try to improve that credit score, besides just kind of getting a handle on that debt portion and paying some of that off. So again, annualcreditreport.com, a really great place to start if you do not have a financial institution that offers the option of looking at your credit report, or maybe you don't have the option of a credit card yet either. Annual Credit Report would definitely be what I suggest that you check out your credit report on and really kind of verify and look at that. A lot of times I get asked, what about credit repair companies? What do you think of those, or should I reach out to them? I'm of the belief that if you are looking to improve your credit score, you can do it all for free yourself. It may take time, it may take patience, and it may seem a little bit overwhelming sometimes. But that compared to paying somebody to do exactly what you could do, a lot of times we have a lower credit score because we don't have the money to pay our debts. So if that's the case, then should you really be paying somebody to help you repair your credit? It doesn't seem to make sense financially, but for your, it may make more sense for the sake of your mental status. I don't know. So, whatever you choose, what I would say is credit repair companies, make sure that you start at HUD.gov. Because HUD really kind of regulates a lot of things, whether there's, how much they can charge you, what fees they can charge you for, how to work with you. Whereas a lot of credit repair companies that are not affiliated with HUD kind of do their own thing and will charge you what they want. And really may not even be doing a lot of what they tell you that they might be doing. So just be very careful when it comes to that. Excuse me. Other than that, that is really all that I have. I see that there is a chat. Can I enlarge my screen? Was that for the actual credit report? Maybe. Unfortunately, I could not. It's a scan, so it's a PDF. So I apologize for that. But once you actually pull your credit report, you'll be able to actually see it full page. So hopefully that is helpful. Other than that, any questions?